Let's now turn to the advisory and take a look at property investing, particular methods you can use to best capitalise on the property market. Julian Fadini is Property360 founder. He joins us now. Julian, welcome.
Thank you, Andrew. It's great to be here.
So, given what we do here, we often talk about equities. There's often that debate between equities and property. How do you look at this and where you see the advantage in investing in property?
The real key advantage to investing in property is the amount of leverage that you can get from the banks. That's one of the big differences most people will find. If you go to the bank and you want to borrow some money against a share portfolio, more likely than not, they won't give you the same amount of leverage that you could get for a house. So real estate is considered an asset that is far safer from the bank's point of view to leverage, and that leverage can really help people grow wealth a lot faster.
So how do you see the current market, given we are actually in a rate cutting cycle? To what benefit is that for property investors at the moment?
So the benefit is more than twofold. So obviously it's cost less to hold property, but the other side of that is the property market will start to grow again, and it already has. The signs are already there in the market that more people are coming off the sidelines now. There's a fair bit of pressure on household budgets, and that's well documented in a lot of, in most places that you pick up a paper these days. And so with the rate cuts in play at the moment, it gives more confidence to the people in the market and getting into the market. And so therefore that's how that takes place. That's how
well, it's all very well to invest in property. The question is what sort of property and where. We often hear about its location. So how do you identify those best opportunities?
Yeah, so we're East Coast focused. The majority of the people in Australia do live on the East Coast. The East Coast has plenty of opportunities, and it's quite a vast space. So our philosophy at Property360 is that we like to look for the properties that suit the owner-occupied market. Now, obviously we represent investors and only investors in the work that we do. However, most of the market is still made up of 100%. About 70% of most markets are made up with owner-occupiers, people that have either paid off their home or paying off their home. And so owner-occupiers are the ones that really drive the prices. Investors come and go, so we look for properties that are suitable to the owner-occupied segment of the market.
Okay, how do you distinguish between those opportunities, be it city or regional areas, houses or units, for instance?
Yeah, perfect. Well, look, the unit conversation for us is that houses are in limited supply, and there's a finite amount of houses. And if you look at land space and developable land space, it's very different to looking at airspace and the amount of apartments that can be brought to an area. Fundamentally, property market is a supply and demand driven market, and so therefore we find houses will be less and less the norm into the future, and therefore that scarcity is what we look for in order to put the odds in property investment favour of our clients.
So when you're looking at this through an investor lens, then you can look at both capital growth but also yield that can be achieved. How do you get that balance right?
Well, the only way to get that balance right is to do your homework and really spend the time and effort and the money involved in carrying out research and looking for those opportunities. Those opportunities are out there if you know where to find them, and that's where we bridge that gap for the client in our professional services, is that we provide that personal and tailored approach to finding those right types of properties.
So what sort of growth targets are you looking at?
So most of the markets that we operate in, when we look back over 10 years, we're getting somewhere between that 6 and 7 compounding average capital growth rate over 10 years. In the marketplace, in some of these marketplaces, it's been far more exciting than that in the last sort of 12 months and 3 years, and more like in the double digits. But on average, we're kind of looking in that 6 to 7% as a rolling average over the 10 years. And then if we can then also consider what factors will keep the supply tight in that area, then we should be able to track that into the future.
What factors do keep supply tight then?
Well, development approvals and land supply, and so for example, if you look at Sydney, for example, if you fly into Sydney, when you look out both sides of the plane, one side you see a lot of water, and the other side you don't see a lot of spare land. However, if you fly into Adelaide, Perth or Melbourne, you look out each side of the plane and all you can see is flat land as far as the eye can see. Flat land is a subdivider's dream. And so therefore you can see the urban sprawl will be able to be moving out into those areas well and well into the future.
And Julian, what sort of yield should you be looking for if you're an investor to make it sustainable?
Yeah, look, 5% is a great yield as a starting point. You know, some people will chase higher yields, and there are higher yields out there in residential property. And if the yield is slightly lower than 5%, it doesn't necessarily mean the property is not a good investment. But for our fundamentals, we look at a starting point of around that 5%.
Now, perhaps a more recent phenomenon in property has been rent vesting. Why would you want to go down that path? What are the positives?
So the positives are that, particularly in the case of Sydney, you may be able to improve your quality of life by living in an area that reduces your commute, you simply may not be affordable for you to get on the property ladder on where you are. So that doesn't mean that the area that you grew up in is the only place that you could invest in property. So rent vesting allows you to look at the market as a whole and look for the fundamentals, where if I'm going to invest this amount of money, what sort of return am I going to get and what sort of growth am I going to get? And that over that period of time, that will surely beat your money being in the bank or doing nothing.
Although I guess the downside is when it comes to selling, you're going to be hit with capital gains.
Correct. There's actually no way around the ATO. So at one stage in the process or another, you'll have to open your wallet for the ATO.